The US-China trade war has re-erupted, casting a long shadow over the global economy. This conflict, which has simmered for years, is now boiling over, threatening to reshape the dynamics of international trade and cooperation. The stakes are higher than ever, with both nations doubling down on their positions. What began in 2018 with tariffs on solar panels and washing machines has escalated dramatically. These initial measures, seen by many as symbolic, have since evolved into a full-scale economic confrontation, with each side targeting key industries to maximize pressure. In April 2025, former President Trump, back in the Oval Office, imposed a new round of tariffs on Chinese goods. This move, aimed at addressing what he described as unfair trade practices, has reignited tensions that had only partially subsided during the previous administration. These tariffs, reaching a staggering 125%, represent a significant escalation in the ongoing economic conflict. The sheer scale of these measures has left businesses scrambling to adapt, with many questioning the long-term viability of such aggressive policies. China, refusing to back down, responded with retaliatory tariffs of equal magnitude. This tit-for-tat strategy underscores the determination of both nations to assert their economic dominance, even at the risk of mutual harm. This tit-for-tat exchange has sent shockwaves through international markets, raising concerns of a full-blown trade war. Investors are on edge, with stock markets experiencing wild fluctuations as uncertainty looms large. As the world's two largest economies lock horns, the stakes have never been higher. The ripple effects of this conflict are being felt far beyond their borders, impacting nations that rely on trade with both the US and China. The initial salvos of this renewed trade war have already disrupted global supply chains and fueled uncertainty in financial markets. Factories are halting production, shipments are delayed, and consumers are beginning to feel the pinch as shelves go empty. Businesses and consumers alike are bracing for the impact of higher prices and potential shortages. From electronics to everyday goods, the cost of living is rising, and the economic strain is becoming increasingly evident. This latest chapter in the US-China trade war raises critical questions about the future of globalization and the balance of economic power. Will this conflict lead to a rethinking of global supply chains, or will it further entrench the divide between these two superpowers? The question on everyone's mind is simple, yet profound. Who will blink first? Both sides are playing a high-stakes game, with neither willing to show weakness. The answer, however, is far from straightforward. The complexities of this conflict go beyond tariffs and trade deficits, touching on issues of national security, technological dominance, and global influence. Both sides have dug in, seemingly prepared to weather the storm. The resilience of their economies and the resolve of their leaders will be tested in the months and years to come. Understanding the potential consequences of this trade war requires a deep dive into the strategies, strengths, and vulnerabilities of both the US and China. The outcome will likely hinge on who can endure the economic pain longer. This is not just a trade war, it's a high-stakes game of economic chess, and the world is watching with bated breath. Every move is being scrutinized, and every decision carries profound implications. The outcome will have far-reaching implications for the global order, shaping the geopolitical landscape for years to come. The world waits anxiously to see how this chapter in history will unfold. One of the most significant developments since the trade war's initial volley in 2018 is China's reduced reliance on the US market. This shift, while not immediate, has been a deliberate and calculated response to the economic pressures imposed by the trade war. Chinese policymakers and businesses, recognizing the vulnerability of depending too heavily on a single trading partner, have been actively diversifying their economic relationships. This diversification extends beyond trade, encompassing investments, technology partnerships, and regional collaborations. This strategic shift is evident in the numbers. The data paints a clear picture of China's evolving trade dynamics. In 2018, exports to the US accounted for nearly 20% of China's total exports. This heavy reliance on the US market was a double-edged sword, offering significant economic benefits but also exposing China to substantial risks. By 2023, this figure had plummeted to just 12.8%. This decline reflects not only the impact of tariffs, but also China's proactive efforts to reduce its dependence on the US. This decoupling from the US market, while gradual and ongoing, has provided China with a significant buffer against the impact of US tariffs. It has also allowed China to explore new markets and strengthen ties with other global players. While the tariffs undoubtedly sting, their ability to inflict crippling damage on the Chinese economy has diminished. This resilience is a testament to China's ability to adapt and innovate in the face of adversity. This newfound economic resilience grants China greater leverage at the negotiating table. It allows Chinese negotiators to approach discussions with a sense of confidence and a broader range of options. They are no longer as susceptible to U.S. pressure as they once were. This shift in dynamics has altered the balance of power in trade negotiations. Furthermore, the Chinese economy, while experiencing a slowdown in recent years, has become more self-reliant. This self-reliance is driven by a growing emphasis on domestic innovation and consumption. Domestic consumption is playing an increasingly important role, reducing the dependence on exports for growth. This shift is fostering a more balanced and sustainable economic model. This internal rebalancing, while presenting its own set of challenges, further strengthens China's hand in the trade war. It also signals a broader transformation in China's economic priorities. The U.S., in its attempt to gain the upper hand, may have inadvertently pushed China down a path of greater economic independence. This unintended consequence highlights the complexities of global trade strategies. This unintended consequence could have lasting implications for the global balance of power, reshaping alliances and economic dependencies in ways that are still unfolding, potentially diminishing U.S. leverage in the long run. As China continues to adapt and evolve, the ripple effects of these changes will be felt across the global economy for years to come. China enters this new phase of the trade war not just as a participant but as a dominant player with a carefully calculated strategy. Its approach is multifaceted, blending economic, political, and resource-based tactics to assert its influence on the global stage. Armed with a potent arsenal of retaliatory measures, China has demonstrated its ability to adapt and respond to external pressures. These measures are not limited to tariffs or trade restrictions but extend to leveraging its control over critical resources and industries. One of their most powerful weapons lies beneath the surface. Literally. Rare earth elements, often overlooked by the general public, are at the heart of this strategy. China controls a vast majority of the world's rare earth elements, which are indispensable in the production of modern technology. These elements are the backbone of industries ranging from consumer electronics to renewable energy and advanced military systems. These elements, with names like neodymium and dysprosium, may sound obscure, but their significance is immense. They are the unsung heroes of technological innovation, enabling the miniaturization and efficiency of devices we use every day. From the smartphones in our pockets to the electric vehicles on our roads, and even the sophisticated military hardware that ensures national security, rare earth elements are indispensable. Without them, many of these advancements would grind to a halt. China, recognizing the strategic importance of these resources, has not hesitated to use them as leverage in the past. Its control over these materials gives it a unique position of power in global trade and diplomacy. In 2010, during a territorial dispute with Japan, China restricted rare earth exports. This move sent shockwaves through global supply chains, highlighting the world's dependence on these critical materials. The impact was immediate and far-reaching. Industries reliant on these materials faced disruptions, and governments were forced to reconsider their supply chain vulnerabilities. The message was clear: control of these critical resources gives China significant power on the world stage. It is a reminder of how resource dominance can translate into geopolitical influence. In the current trade war, China has already shown a willingness to use rare earth elements as a bargaining chip. This tactic underscores the interconnectedness of global industries and the risks of over-reliance on a single supplier. American companies, particularly those in high-tech sectors, are feeling the pressure. The potential for supply disruptions has forced many to explore alternative sources. Though such transitions are neither quick nor easy, the potential for further restrictions on rare earth exports looms large, creating uncertainty and vulnerability for U.S. industries. This uncertainty ripples through the economy, affecting not just corporations but also workers and consumers. Beyond rare earths, China holds other economic cards it can play. Its influence extends to other sectors, including agriculture, where it wields significant purchasing power. As a major buyer of U.S. agricultural products, particularly soybeans, China has the ability to target this sector strategically. This is a critical area of vulnerability for the U.S. economy. Targeted restrictions on these imports could inflict significant pain on American farmers, a key constituency for the current administration. The ripple effects would be felt across rural communities and beyond. This ability to target specific sectors of the U.S. economy gives China considerable leverage. It is a stark reminder of the complexities and interdependencies of the modern global economy, where economic power can be as influential as military might. While the U.S. retreats behind tariff walls, China is actively strengthening its economic ties with other nations. Beijing sees the trade war as an opportunity to reshape the global trading system, one less reliant on the U.S. dollar and more aligned with its interests. This ambition is evident in China's diplomatic and economic initiatives across the globe. One of the most ambitious projects is the Belt and Road Initiative, a massive infrastructure development program spanning Asia, Africa, and Europe. The Belt and Road Initiative, often described as a modern-day Silk Road, aims to connect China more closely with these regions, fostering trade and investment. While the initiative has faced criticism for its debt-trap diplomacy, it demonstrates China's commitment to building a multipolar world order. In East Asia, China has taken advantage of the U.S.'s inward turn to strengthen ties with Japan and South Korea. The three nations, after years of strained relations, have resumed economic dialogue and are exploring the possibility of a trilateral free trade agreement. This move, if successful, could significantly reduce U.S. influence in the region. Southeast Asia, another region crucial to U.S. interests, is also witnessing increased Chinese engagement. Beijing has been actively courting countries like Vietnam, Malaysia, and Cambodia, offering trade deals and investment opportunities. These efforts, coupled with the U.S.'s withdrawal from the Trans-Pacific Partnership, have allowed China to expand its economic footprint in the region.